Welcome everyone to the Kendall Report, where I share my 42 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, another ugly day. Had a lot of folks telling me in the comments on the video last night that I was wrong and that inflation was good for the markets. I don't believe it is. There is some long-term times where we see it be good, but it wasn't good in the 70s, and it's not good right now. There's a lot of reference to maybe Japan in the 1980s. We're not Japan in the 1980s. We are the U.S., in the 2020s, and this is a tough place to be. The world has changed substantially with all of the printing of money and everything that's went on and disruption. And we see these crazy scenes from China right now. You have to wonder what's going on. And I think it's getting more and more difficult for investors and speculators alike to be positive about the markets. It's one of those things where you watch these markets long enough, you start to get a feel for what's really going on. And I can tell you, and I've mentioned this before, and I want to talk to you a little bit about it tonight, is that really what we're seeing is just a complete loss of confidence in the system. And I've said this before, we're seeing it happen across the board from the standpoint of, you look at interest rates and bonds, we're printing up in the 270 handle on the 10-year. I've been talking about that getting up to maybe 3%. The only positive thing I'll cover in a few minutes is that the yield curve is no longer flattening. It's actually been steepening for the last several days, and it's no longer inverted on the 530s. I'll cover all that here in a second. But basically what we're looking at is a very changed world. And the administration and other folks around the government are trying to get ahead of this inflation monster, CPI comes out tomorrow morning. Markets are under a little pressure overnight, but we're seeing just a lot of expectation of an acceleration. We're looking at CPI expected to come in year over year at 8.4 and the monthly up 1.3. And I talked about this. This is looking in a rearview mirror. We have seen crude oil and gasoline come in pretty good, actually. We're printing well under 100 on crude oil, but the bottom line is there's still a lot of other things that are inflated, even though we're starting to see basically some of the air come out. And you ask why would that be happening? I think it's happening because now we're starting to build in that expectation of recession. Maybe that talk is getting a little too loud at the moment, but there are a lot of things that are starting to deteriorate, and I've been talking about them on the channel for a number of months that I'm seeing these things happening, and sometimes it's like watching a slow motion train wreck, and that's what we're basically seeing right now is just one component after another just coming apart, and this confidence thing that I'm talking about is really huge. So yesterday, S&P down 1.7, Nasdaq down 2.2%, and Russell down 0.7. Energy down 3.1. So we're starting to see a lot of things roll over in the energy sector, XLE, all the different ETFs. A lot of things are starting to roll here. And I've been talking about this, which I'll go through the details here in a few minutes. We had targets for $79 on crude oil. I don't think that's realistic, but we're finally, I think, starting to maybe hit the extremes, and I'll go through that as well here in just a minute. Let's go ahead, and it shouldn't take too long to get through the broadcast tonight. Everything's pretty straightforward. So let's go ahead and take a look at the database so you can see what is going on there. So let's get into that. So the daily database is down to 40.91. You know what that means? We're below 42%. So we're starting to see more of a contraction in the database. And this is not a good sign at all. This is suggesting we're going to see more deterioration of the internals of the markets, and that's going to most likely lead us to some lower prices. So we're looking right now at, there was 789 sell signals, 130 buy. So we had a negative rotation again on the short-term basis. And as I've been talking about for a while now, there is no traction coming in on intermediate. There shouldn't be, as a lot of these intermediate and longer term trends are still accelerating to the downside. And I just, if you recall, I told you that the probabilities were on my side because Jim Cramer said that it was going to bottom very soon, but then he flipped and said, be cautious. So he's, either way, he's going to be usually on the wrong side when he's flipping, and he already told everybody it's just a classic, right? I don't mean to bring Cramer into the room, but it's just kind of funny to watch. There's a couple of people, I spent a little bit of time this morning watching some CNBC stuff, and it was pretty comical, I think, for the most part, what's coming on and what the public's being told about what's going on with this market. And it's not pretty, folks. There's no way this database doesn't get blown up like this. It's not that bad on a daily basis, but it looks to me it's going to deteriorate. You'll see here in a second when I go through the technicals that there's a lot of things that are likely to continue on from that standpoint. Real quick, I'm just going to bring up TradingView. This is our day trading setup with the indicators, the Wavetech indicators, and we're starting to maybe find a little bit of support down here on, this is a 5-minute, 1 minute, and it's also got the price projection tool, the Fibonacci tool here. So it looks like maybe we're finding a little bit of stability for the moment. PPMs are starting to turn up, so that's encouraging from that standpoint. Let's go ahead and take a look at the longer term. What we're seeing here is we're sitting right down on the 40 period moving average right now. That number is at 43.90. The low so far overnight, 43.8925. So we've touched that. You're seeing the PPMs here. PPM 1 is now at a minus 0.52 and trend mode down. The only thing that's happening here is that the 10 period moving average is at 45.01, but it's rolling over. When we get a crossover of the 40 and the 21, that could set up a little minor low here for a couple of days. I think we're starting to get at a point where we could stabilize, but if we don't hold the 40 period moving average, which we've already tested overnight tonight right now, 43.90, then we're going to be looking at these Fibonacci numbers I've been talking about for the past several days. You'll see these dots down below the chart here. Those are suggesting that a move down, the minimum move is 43.50, and below that level is 42.43, 41.76. And I think if we get down to these lower Fibonacci targets, that we're likely going to retest the lows. 40.93 was the actual low on the futures going back several weeks ago. And so this is actually starting to deteriorate. You see all the PPMs are rolling over. The only one that hasn't rolled so far is PPM 2, but I think it's very close to starting to move down. But the key is going to be this 40 period moving average, which, right as I mentioned, is 43, get to the right number here, 4390.98. So we're trading right on that number at the moment. So a close below that level tomorrow is going to set up an acceleration. Now we've got the news, as I mentioned, coming out here just on the open with the CPI. So whether that's going to be a surprise or a really ugly numbers baked in, but they're really trying to make this look like everything is already known, and that they'll probably start to hear the stories that the inflation is already all baked in. We're peaking out. We may be actually, but the point is that we're not seeing things. There's a couple other things that are happening out in the marketplace and in the economy, as we're seeing actually the demand for shipping start to fall, which is a recessionary sign. Not the cost of the shipping, which that has come down, but the actual demand or the number of packages being shipped. I was very fortunate back in the 80s that one of my clients worked for a firm that made cardboard boxes. And he had been there for quite a few years when I met him in 1980. He was a bit older than me. And he was telling me that they could always tell when a recession was coming on by how many cardboard boxes they made, the machines that made the boxes. Now, how many of these machines they would sell. And so it was kind of interesting. It was a great indicator. In fact, in 1980, it was a perfect indicator for what was going on at that time. And that was right when we were looking at, you're going to hear tomorrow that the inflation numbers are, last time we seen that was 1981. Well, that was when inflation numbers were improving in 1981. They were much worse in 79 and 80 when Paul Volcker was jacking rates up, trying to get them to come down. We basically peaked in rates around that period of time. But the bottom line is that we are starting to see some softening in the economy. There are some prices starting to come back, some of these commodity prices, but that doesn't necessarily mean that we're just everything's going to get better. And the reason that means inflation is not going to be as bad. It might be the case, but if we're actually getting the numbers from shipping demand to come down, that means there's also something else going on in the economy. So we're going to start to see some earnings come out on Wednesday. We've got some banks coming out, and then also on Thursday. It's pretty minimal stuff, but we are going to get a glimpse into this earnings season. And I don't expect that earnings will be bad. It's really the forward guidance that everybody's going to be listening to. So we'll see how that starts to go in the next several weeks. We're going to be hearing a lot about that. Next market I'll cover is the Nasdaq. Well, we've already gotten through the 40 period on the Nasdaq. It's down 80 handles right now. So we're starting to look at, in fact, since I just started talking, we're seeing a sell-off again in the futures. But we're looking at right now, looking at the market grid. S2 is 13,825. We've had a low of 918. We're actually printing right at S1 right now. We get through that, I think we'll see S2. We didn't quite get an STX buy signal on the Nasdaq. Yesterday, the low was 13,984. 13,955 was the STX number. And then we saw the close right at 14,000 exactly. But we're seeing some follow through overnight. We're continuing to see some downward pressure. This CPI news will be out before the opening, so this will be an interesting metric to watch. But we're seeing the deceleration of the PPM1 is now at a minus 0.89. And PPM2 it's the same kind of configuration that's on the S&P. It's actually positive. It's actually showing it's in trend mode, but this is an interesting inflection point. A lot of times when you're seeing these moving averages start to roll over, you're going to get the cross. So it won't be today. It will be tomorrow. We'll get the crossover of the 10 going through the 21. And then we'll start to see that 10 period moving average come in and ultimately probably cross through the 40 if we accelerate. And just like with the S&P, the Fibonacci numbers 13,822. And then we have 13,269, and then 12,928 is the extreme. So we're definitely seeing a continuing deterioration and a rolling over of this market. I had talked about if we could hold the 21 period moving average several days ago, that we could set up maybe a right shoulder, where we're starting to correct too deeply now to start to call it a right shoulder at this time. So it's going to get very interesting the next 2 sessions. Next market we'll look at is the Russell. The Russell continues to move lower. It outperformed yesterday. It was only down 0.7 when the Nasdaq was down 2.2. But regardless of that, we're still got some pretty ugly numbers here on PPM1 is minus 0.47. PPM2 is not in the same configuration. And I've been talking about, I thought this market might be the one to lead us off the floor. Well, we got this cycle, what I thought was going to be a cycle bottom, and ended up to be a cycle top. And now we're seeing this acceleration to the downside. So it's the next 2 sessions, like I said, are going to be critical, especially if we can't close higher in the next 2 sessions and get back above the 40 period moving average 2037. That's actually a pretty big order at this time. Next market we'll cover is the 10-year. 10-year just continues to move higher. I talked about these new Fibonacci targets up here above the market, 3.13, 3.46, 3.6. I think it's realistic to get up to the 3.13. The taper tantrum high was actually at 3.25. It was actually, I think, technically a 3.23 high. And so we look at the weekly here. We're just continuing to see this trend expand. We are about 2 weeks away from getting into that rising 10 pattern into the market grid. So there's still a lot more to go on this. We're going to stay stable well above 250, 255 in this pattern right now. I mentioned earlier that the yield curve had started to steepen again. Let me show that to you here. This is the 530, and you'll see that we're back up positive of 0.35, and it's really moved pretty decently over the last couple of days. And I talked about this a bit, I believe, 2 sessions ago. It's not the fact that we just inverted. That's not the signal. We need to stay inverted for a while. And we saw the same kind of situation. It was interesting, just flashing back. 2018, there was a bit of a blip there. We never really got to the inverted stage, but in 2006 was the last time we really got to that inverted stage. Let me bring that up on screen here so you can see those numbers. This is the monthly. And you'll see in 2018, we got just about to 0.23. Now we've taken that out. And in 2006, the number was 0.98. And recently, we actually were able to print down well below that on a daily basis. But on a monthly basis so far, we have not really exceeded the 2006 levels on a monthly close. Of course, it's just now almost mid-month. It's hard to believe, almost mid-month of April. So, but this overall pattern, we need to stay inverted for there to be a real issue here from a signal to the economy. And then we're still close to a year plus out before we'd see any kind of recession. But I think we're in a much different situation now than what we've been in the past, is that there's so much sensitivity, and market participants are starting to act a little bit differently than they have in previous cycles. And that's also important. A lot of folks will always look back and say, well, in 1981, this is the last time we had inflation like this. But my argument always is that the fact that we have the similar numbers, you have to look at the context which things are happening in. And things are much different today than they were in any previous period. No matter how you try to compare the past does not equal the future. And that has always been something I've said for many years. It's good to look back at the past and what happened, but you have to look at the context of where we are right now. And this is a much different scenario. You know, in 1981, everybody thought we had big debt. Well, we have big debt now. We have, over $30 trillion. We've got, I won't go through all the metrics, but we have these huge metrics out there that have never been seen before. And then we've got, in the combination of everything, we've got, geopolitical risk. We've got everything stacked up at this one moment in time. So this is likely to continue to be an issue as we go forward, at least in the near term. But comparing too much to the past and taking past expectations, I always laugh, actually. I see people that have, I'll do air quotes, CFA, certified financial analysts, that their whole analysis is based off some trend line, a 40-year trend line. It's just a very amateur analysis that goes on with a lot of stuff that you see out on the street and a lot of stuff that you see out there. They're just trying to make too many comparison, and maybe a 40-year trend is being broken, and maybe that means something. But it's obvious that there is a different context than any other time in history. So be careful about trying to compare some of that stuff. So next market we'll cover is the crude oil. Crude oil's up 1.64% right now. I still have a feeling we're going to get back above this, what I call the demand line here, which is the 10-period moving average. It's also on a weekly basis. This is a weekly chart here. On a weekly basis, it's around 100. I think we'll get back toward that 100 level probably before the end of the week. I'm not sure. We're just going to continue to decline. You can see that PPM1 is still, even though it's crossed its first, second derivative, still up at 0.67. This is weekly. 1.33 on PPM2. So there's substantial amount of support at that level, which is currently 86.50. Don't think we're going to get to those levels, but when we look at the daily chart, I think there's something interesting starting to show up here. I think possibly that yesterday's decline was the climactic move in this pattern. Now what we're going to be looking for is a move back above toward that 100, get back above 99.33, and we're seeing PPM1 starting to turn up, and there's still a lot of downward pressure there. So it's going to take about 2 sessions to stabilize, and you see PPM2 starting to turn up, and PPM3 is not far behind it. So I suspect that we'll be printing back above 100, maybe 102 here in the next several days. Next market I'll look at is gold. Gold continues to act reasonably well. We're at 1958, up 1060. We're continuing to stay above those moving averages that I've been talking about the last couple of nights. All of a sudden, PPM1, 0.21, we're almost in trend mode. You see the PPMs all turning up together. The expectation now is for the potential to move up toward some of the Fibonacci targets. 1965 would be minimal, and then 1992 is next level above that. So things might start to move fairly quickly here, but this is encouraging the patterns that are set up here on the daily charts. Let's go to the weekly for a minute. Weekly is just continuing to climb along that rising 10 inside of that pattern of the market grid. I talk about it all the time. It's one of my favorites. The 1932 level is major support, so all we need to do on a weekly basis is stay above that level. Next market is Bitcoin. As I talked about last night, Bitcoin has become a risk-on, risk-off asset with the market starting to decline. Well, we're starting to see declines here as well. I haven't looked at the daily charts. We'll do that in a minute, but we're seeing a complete reversal. PPM1 is now minus 0.81, 1.90 on PPM2. So now the major resistance now 43. We had to hold 41 to be good. We didn't do that. Let's see if there's any new targets on the downside here. There is not yet, but we are breaking through the STX number on a daily, 40,778. Last trade, 39,498, 500. So a close here, and this is about 2 hours from now, would suggest a little bit of a sideways move. But this PPM1 is now minus 1.70, which is telling us that we're got major resistance, 42 to 43 now. So we've inverted this from having a support levels that we're like trying to start to see another decline. No Fibonacci projections at the moment. Nothing out there that looks interesting from that standpoint. But we are seeing the PPMs, this massive acceleration to the downside. So this market is going to continue to see some underlying weakness here for the next several days. Okay, folks, that's going to do this broadcast for tonight. We had a good session in the live session today. Make sure that you go and take a look on, let me go to this screen here. This is the place to get the indicators. Get signed up. Quite a few people signed up over in the last couple of days. Make sure you see that master class that I did. It was really focused on the PPMs, but there's covered some other things. I'm probably going to do some live cast here and continue that series. So there's going to be a series of these things. I'm just going to light the screen up and go through a lot of these. I'm working on another script right now for going through the webs and the Fibonacci targets, which are significant in the arsenal of these tools to be able to trade off of. So anyway, folks, as always, thank you for watching, and I will see you tomorrow night on the channel, and same time, same station. Take care. We'll see you then.